Silver has moved from strong to historic. Prices have cleared $41 to a 14-year high, while gold sets fresh records. Crucially, the White House has said gold bars will not be tariffed and flagged a clarifying order after a CBP ruling implied duties on common bar sizes. There's been no parallel assurances for silver. That split turns a price rally into a market structure story. It matters less for the headline and more for the plumbing, because where metal is held, how it is financed, and whether paper hedges continue to track physical costs are the questions that decide who is protected and who is exposed when policy risks rise. The facts are straightforward. New York has been trading rich to London by roughly 2/3 of a dollar an ounce at times, and short-term silver borrowing costs in London have printed above 5%, both signs of tight lendable supply and a bid for immediacy. Reports indicate some Swiss European flows paused during the gold bar tariff confusion and then prioritised gold once Washington's stance was clarified. Meanwhile, elevated arbitrage have encouraged silver to move toward US delivery to monetize the premium. The result is visible strain in the pipes. Lease costs have been elevated, exchange for physical premia widened, delivery activity has been brisk on near-my COMEX contracts, and inventories are being reshuffled toward the jurisdiction paying up. Uncertainty around how silver will be treated keeps that tension alive. The past few weeks show that precious metals still live in a real economy. Silver is being asked to meet an industrial cycle that needs reliability and an investment cycle that wants insurance. Borrowing costs in London have risen. New York has traded rich to London, and exchange for physical flows have tilted towards immediacy when tariff risk rises. It is the market prizing possession over exposure when the rulebook may change. Policy explains the timing. In April, the administration opened a Section 232 investigation into processed critical minerals. In late August, the US Geological Survey put silver on its draft 2025 critical minerals list. Drafts do not impose tariffs, but they change behavior. Once a metal is treated as critical, inventory norms creep higher, custody shifts closer to home, and willingness to lend physical falls. Now, copper offered a kind of rehearsal to us in July. A 50% tariff landed on a range of semi-finished and derivative copper products, while refined cathode wasn't covered by that immediate 50% measure. So structure, not just headline rates, drove the arb. And expectations inverted, the arbitrage into the United States collapsed and prices fell hard. The lesson for silver is to watch scope and tariff annexes more than headline percentages. Now, macro has added a tailwind to the silver price here. Markets lean towards easing at the end of the mid-September FOMC, which typically supports monetary metals by lowering expected carry. Global bonds remain unsettled by heavy issuance, sticky inflation risk, and questions about central bank independence. Seasonality matters at the margin, since September and October often test equities, and investor demand has reinforced the move. TD Securities has highlighted depleting free inventories, liquidity tightness, and a bullish setup that can feed momentum. The Silver Institute still sees a fifth consecutive annual deficit in 2025. Magnitude estimates vary across summaries, helping explain why dislocations don't vanish when headlines quieten. Now, the market is not pricing a foregone silver tariff. It is pricing policy optionality, a copper-style design that protects value-added imports but spares refined bullion and raw inputs would likely compress the New York premium, soften lease rates, and cool pre-positioning, with more of the cost felt downstream. A maximalist design with few exemptions would keep regional premia sticky and borrowing costs elevated. Even with no tariff, the critical label hardens behavior and keeps inventories and local custody higher for longer. Mechanics are straightforward. A tariff on ore or doré hits mines and smelters. A tariff on refined bullion reaches straight into the vault's settlement and the forward curve. A tariff on components pushes cost into manufacturers and consumers. Refiners reallocate capacity when noise rises. So if a plant is recasting gold bars after gold's clarification, it isn't clearing a silver backlog. Stress appears first in lease markets and then in visible inventory. The location basis is the map of this behavior as ships follow the premium until it closes or freight stops paying. Now, an Austrian style reading is useful here because prices coordinate dispersed knowledge. Tariffs interfere with that signal and push decisions towards tax codes and customs classifications rather than scarcity. Now, copper showed how quickly price adjusts once detail arrives. Silver is running the same decision tree while straddling industry and money. So, what should investors and operators watch for here? We'll focus on the pipes. Lease rates show whether the lendable pool is loosening. Exchange for physical flows and delivery candles reveal pre-positioning. The New York to London basis tells you where the premium resides and whether arbitrage is still paying. If these gauges exist without fresh policy steps, behavior is normalizing. If they remain taut, the private sector is still paying for certainty. Now, none of this asks physics to change. Electrons still prefer silver's conductivity, and supply chains still prefer predictability. Lower loadings in solar cells shave sensitivity, yet scale keeps absolute demand robust. A modest tariff can be modelled. A policy fog that scrambles routing and financing and inventory practice is a different problem because friction compounds along the chain. Two facts frame my conclusion here. Silver has pressed to fresh highs while gold has a public assurance of bar exemption and silver does not. So keep some cash for premium dips, add in your cost averaging plans, favor fully allocated holdings, and pre-position ounces where you might actually need delivery. Watch local premiums, delivery times, the New York to London basis, and lease rates. If bullion codes are spared, plumbing should calm and premiums should narrow. And if not, those gauges will tighten first, which is your cue to accumulate patiently on premium softness rather than on headlines. And if you want to talk to us more about this or you want to learn more, then click on the link below and download one of our free guides.